Holistic Plan presents Tax Time with Jeff Levine. Let's talk taxes.
Hello everyone, Jeff Levine here, and it is great to be back with you again. With our time together today, I want to take a few moments to talk about the Qualified Business Income Deduction, or the QBI deduction, sometimes referred to as the 199A deduction after the portion of the tax code where it is found. You may hear it referred to as the 20% pass-through deduction. And the reason is this is a deduction that is equal to up to 20% of the business profits of an individual who has a pass-through business. Pass-through businesses include businesses such as sole proprietorships, LLCs, S corporations, partnerships. So a wide variety of business structures are able to potentially benefit from this deduction at the owner level. And that's really unique. That's something that's very interesting and unique about this QBI deduction. It is a deduction attributable to business income, but it is reported on an individual's own return. So based on certain characteristics of a business owner, you might have, let's say, two individuals who are equal partners in a business, and they do exactly the same thing as one another, and they get exactly the same pay as one another. But because of the characteristics of the rest of their tax return, let's say total income, for instance, whether they're married and they have a spouse who makes a lot of income or not, they may get a different QBI deduction, again, despite working in the same or being the same percentage business owner of the same business, doing the exact same work, and getting the same compensation from that specific business. So it's a deduction on the personal tax return. And one interesting element of it is it's a deduction that's unlike any other. It is truly a unique deduction in a class by itself. Historically, before the QBI deduction was created, deductions fell into one of two categories. Either they were below the line deductions, or so-called itemized deductions, and you had to itemize in order to benefit from those, but they wouldn't help lower your AGI. Or they were above the line deductions, which you don't have to itemize in order to benefit from, and they do reduce your AGI. Well, once again, the QBI deduction exists in a class of its own. It does not reduce one's AGI. So adjusted gross income remains the same regardless of the size of the QBI deduction on a business owner's tax return. But you don't have to itemize in order to claim it. In fact, you can claim the standard deduction and a QBI deduction. So it is really a unique animal in and of itself. Unfortunately, it's also, though, one of the most complicated deductions there is. For low-income individuals, and I'm going to define low income here in a moment, and you're going to say, wait a second, that's not really low. But for low-income individuals, the deduction is equal to the lesser of 20% of the business income, or 20% of taxable income with some adjustments, such as capital gains backed out, whichever of those is less. So for argument's sake, if you had $100,000 of business income and $110,000 of taxable income, well, the lesser of those is $100,000. $100,000 times 20% equals $20,000. That person would be entitled to a $20,000 deduction. Pretty meaningful, right? Especially when you can get that year over year. So I mentioned that's the case for low-income individuals. So what defines a low-income individual? Well, again, it's not really that low. For married couples filing a joint return, low income here would be those with less than $326,600 for 2020. For 2021, it was actually $329,800. And half of that for single filers. So for 2021, that's $164,900. Makes you, if you have income below that, makes you a quote unquote, in my world here, a low income individual. And that doesn't mean you're truly low income. It just, for purposes of this deduction, that's all you have to worry about, the lesser of 20% of your business income or 20% of your taxable income. Now, as income begins to exceed those amounts, again, about $330,000 for married couples and about $165,000 for single filers, as income begins to exceed it, then things get complicated. It depends upon the type of business that individuals have. Are they so-called specified service businesses, generally white-collar jobs like a CPA, a financial advisor, a doctor, a lawyer, etc.? Or are they a non-specified service business? If it's a specified service business, well, then as income goes above that threshold income amount, the deduction begins to fade away, and there's not really much you can do about that other than trying to lower income. By contrast, if you are a non-specified service business owner, well, then you may still be able to get the deduction if your business pays a certain amount in wages, W-2 wages, to its employees, and or it has enough depreciable property that it owns. But ultimately, the QBI deduction does some really funky things. Really funky things. My good friend Ben Birkin is about to share with you some of these really strange oddities. For instance, can you imagine paying nearly a 50% federal tax rate on income in about the $300,000 to $400,000 range as a married couple? You'd say, Jeff, it's not possible. The top tax rate is 37% at the federal level. We can't have a 50% tax rate. Well, when it comes to missing out on the QBI deduction, there are some really interesting things. And again, Ben is going to show you a few examples of where this can come into play. And if you're looking at, doing the right thing for clients and keeping their lifetime tax bill low, well, you got to ask yourself, when is there a better time to try and reduce income than when 50% or more at certain peaks may be going to the federal government in the form of taxation?
Thank you, Jeff. This is Ben Birkin, Vice President for Customer Success and Engagement at HolistaPlan. And today I'm going to show you just a little bit within the scenario analysis tool for HolistaPlan about how you can visualize some of the impacts that Jeff was just talking about as it relates to the 199A or the qualified business income deduction. I've created a scenario already. So in this particular scenario, I've got a married filing joint couple where one of the spouses makes about $40,000 in wages, but they also have about $300,000 in Schedule C income. Now, one of the nice things about HolistaPlan is that you don't need to worry about calculating the qualified business income or the 199A deduction. We'll take care of that for you. All you have to do is open up the dialog box for the Schedule C income row, and you'll see a few different things. The first is just the income itself, which you want to put in here is $300,000 from the Schedule C, but also how much of that was qualified business income. Now, unfortunately, we're not going to calculate how much of that is QBI and how much is not. In this case, I've assumed that all of it is for example purposes, but you'll want to make sure that you have the right amount of QBI put in there. As well as the amount of the income that's going to be subject to self-employment tax, because that's going to have some implications all over the place. Now, we've already seen down here the QBI deduction calculation. I'll show you. If you had $325,000 of Schedule C income and it was all qualified business income deduction, I'm sorry, all of it was qualified business income, you'll see it's already going to change the deduction calculation for you. But let's go back to the $300,000 level, because that's going to work well with some of the other stuff that we want to show. So we've got everything in here. We've got how much is subject to self-employment tax. We're good. When we come down to the QBI section, and we see we've got the deduction that we just saw in the dialog box, about $56,586. Now, based on this particular client circumstance, their taxable income is about $256,000, almost $257,000, total tax of $74,000, which would put them, if you backed out how much of this was ordinary income and how much of it was investment income, in the 24% marginal bracket. And you might be thinking, 24% bracket's kind of big. Maybe there's some additional income we would realize in there to get it at low rate. Some people are pretty aggressive with Roth conversions, for example, and they might want to take advantage of the 24% tax rate. But the key here, as Jeff was talking about, is you got to be mindful of the phase out for the qualified business income deduction. And to see that, it's easiest to visualize it within the range calc screen, which I've got up on another tab, where you can see that, yeah, well, it's true that the 24% bracket can go on for another $75,000, $77,000 of ordinary income. At just $16,000 or $17,000 of ordinary income, you start phasing out that QBI deduction. And when you add on top of it that at about $40,000, you phase out the refundable child tax credit, it's not too long before you're looking at a 38, 43, 57, 56% marginal bracket for additional $1,000 of ordinary income. Now, all this stuff is too complicated to keep in your head, but when you can put it visually here and put it in front of a client, you can talk about, if we can reduce your income, we can actually save a little bit of money, but we want to be mindful of how much of your income we actually increase, because if we increase it too much, you're going to start losing serious money because of these much higher rates than you would have anticipated just thinking about the marginal brackets alone. Thank you so much for watching. We hope that you get a lot out of your holistic planning experience. We want you to be a good tax planning hero for your clients. Please let us know if you have any questions or if there's anything we can do for you.